Today's episode is brought to you by Dorrington Plumbing, Gas and Electrical, and they provide quality-focused specialists for both residential and commercial plumbing, gas and electrical services. They've been doing this since 1995 and have built up a substantial reputation within the sector. If you're interested in these services, head to www.dorringtonplumbing.com.au.
So hello, I'm Ben Kostrich and this is the Market Bull podcast. Joining me on the show today, it's always fun having him on, is David Hunter, the Chief Macro Strategist at the Contrarian Macro Advisors. He's got such a wealth of experience and knowledge on Wall Street, and as we were saying, he loves speaking on these podcasts and people love listening to him. So welcome back to the show, David.
Yeah, hi Ben, great to see you. It's been a while.
We were saying September was when we last spoke, and all of a sudden we're in June. I don't know where the time flies to. And naturally, since we spoke, Trump has come into office in the US. There's been a plethora of changes that have rippled through global economies, and even in Australia, I think every day there is still constant news flow about tariffs and what's happening. And there's this, well, markets are always changing. But I'd just like to get your thoughts first and foremost from a US perspective on what you feel has really happened since that inauguration and him coming into office and having some pretty drastic changes straight away and some of the impacts of them.
Yeah, definitely. He has not disappointed. It's been an exciting time, or a period certainly where you don't want to kind of ignore the news because it changes every day. There's something big almost weekly. So tariffs, we obviously got hit with the tariff announcements in early April. People panicked, the market went down. People responded to his announcements and the extremity of the tariff increases as if they were going to happen in that way. And I cautioned then and was pretty active on X, saying just let it play out. This is all negotiation. This is how he works. You basically come with pretty strong offers and then try to meet in the middle somewhere. So I think that's still the case. Obviously, the market after panicking has come all the way back. We're approaching the old highs. We're not very far away now, and I think we are going to go much higher. And it's not just the fact that the tariffs will be negotiated and you won't see anything as dire as what it looked like. In fact, I think the Trump goal, the Trump agenda goal, is basically to see freer trade, not more restrictive trade. Yes, we want to bring manufacturing back to the U.S. No, that's a big part of the strategy. And yes, there are going to be some tariffs, but nothing like this. And ultimately, he's trying to, get barriers down everywhere. We've been a big open market for decades. And now we're kind of saying, hey, we're not going to be just giving it away here while you guys restrict us. So, you're moving from something that everybody loved to something that's going to be less advantageous to them, but still a good, they still want our market. So I think you will see ultimately when the dust settles, that a lot of agreements get made that are not nearly as onerous and in fact are pretty good. Certainly good for the U.S. and he's not trying to punish other countries. He wants them to have, plenty of trade too. So I think ultimately tariffs will be put aside as a negative, and then you've got the other agendas, which the big beautiful bill, the tax cuts, the things there. It's still being negotiated, and you got Elon Musk talking the bill down and saying there's not nearly, we're going to see deficits as far as the eye can see, and he wants much more done there. I think he's disappointed that all he did with Doge, the Congress hasn't taken up much there. So right now it looks like that bill's going to be in trouble, but that's how it always looks in Congress. You get to the last, never get an agreement until you get to the last minute. I don't think you're going to see, those tax cuts that are, going to go away if they don't pass this bill. I don't think Congress will allow that, or certainly Republicans would allow that. So ultimately, I think you'll see a tax bill this summer. And then you got deregulation that is really just beginning, and that will be, pro-growth economy. So there's a lot of things, I think, out of this Trump agenda that will ultimately be positive for the markets. Markets are recognizing that now after getting panicked by the tariffs. I think that will help fuel an advance through the summer. My target on, and at the same time, those tariffs in place right now until they get negotiated away are hitting the economy, and all the friction between the different trading partners. It is going to hurt the economy. So I think we'll be in recession this summer, but I think it will be viewed by both the Fed and by the bond market as, time for rates to go down. And ultimately you'll see lower rates, both from the bond market doing it, even if the Fed doesn't, but probably the Fed joining the party at some point this summer, if not June, the next meeting after that. And that will be, some wind at the back of the market as well. So you got all of those things going. I come out, when I put all that together, with a target of 8,000 on the S&P, 27,000 on the NASDAQ, 55,000 on the Dow, and 3,300 on the Russell. I think probably last September, my numbers were lower on at least some of those by quite a bit. So I've raised them, now lowered them. I actually raised my target on the S&P and the NASDAQ right as the market was bottoming back in April. When everybody else was cutting numbers, getting more bearish, I got more bullish because I saw it as a kind of a cleansing sell-off. Sentiment got very negative. So that's, to me, I'm still very bullish. I do believe this is the last leg of a secular bull market that started back in 1982. So it's been a long, long bull market. Obviously, cyclical bears within that. We've had some pretty big sell-offs and bear markets along the way. But from a secular standpoint, it's been up and away. I think we are approaching the end of that. Still this big run to go that's 30-40% ahead, and I do think my targets, as extreme as they are, they're much higher than anybody else on the street. I think they're going to prove conservative. I'm not going to get to the last tick. I'm not going to be able to call that. So I don't know if I'll be raising them or not, but I'm not worried that I'm going to fall short of these targets. If anything, they're probably going to exceed my targets. And then I think sometime this year, whether it's end of summer, beginning of fall, into the fall, somewhere this in that time frame, I think we get to a top here. Which means if you're going to cover that much ground, particularly in the Russell from here, that's 60% plus. If you're going to cover that much ground and do it in the next 6 months, that's a parabolic run. So I think this last run is going to be very steep. It's been steep, obviously, from April to now. I think it's only going to steepen from here. That does not mean you won't have short-term pullbacks, but ultimately, I think most of the next 6 months is going to be in the on the bull side of the equation.
Yeah, there's a lot to unpack there, and you briefly touched on it from a US perspective. So many of the main indexes on that cusp of breaking out, and that would be going to all-time highs that earlier in the year that it was at. And when you look at it on a 6-month basis, I think all the indexes are still down year to date. When you look at them over the longer course, there is just this ridiculous sort of upward trend. And as they typically say, everywhere the trend is your friend. And yes, you alluded to small setbacks, but the catalyst, it's very hard to put an exact pinpoint on when this bust through to the ceiling might happen. But if you're looking at potential catalysts, a handful, and you talked about a lot of them, what might be some of those that push, for example, the NASDAQ through first, or the Dow, or do you feel they're all going to crescendo through almost at the same time within a handful of weeks? Like, what might be the one that leads the charge with the rest to follow?
Yeah, I don't know which one will bust through first to new highs, but they'll all be there pretty much in the same period of time, whether it's the same day or the same week, or within a week or two. They'll all be there. The Russell's obviously the laggard, so it may take it a little bit more, but I think the Russell's going to catch fire here pretty quickly. Once people become aware that the bond market is starting to move up, that rates are starting to move down, that will help the Russell start catching up. So I think that may be just beginning, within days. So, and then the bigger story is not so much which one busts through the new highs first, but really which one's going to outperform. And I think it really will be the Russell. Small caps will have an outperformance here. The others I'm looking at 30 or 40% upside, but the Russell 65% upside. So that's pretty big outperformance. NASDAQ will be second. I do think the Mag 7 will be big players in it. I think semiconductors will be leaders still, including NVIDIA, but also across the board. So tech will continue to play, but at the same time, so will industrials, so will materials, so will financials. I think financials will do very well. You might even see some of the stockbrokers, move up 70 or 80%, certainly 50, 60, 70%. So there's a lot of upside, I think, in a lot of groups. The laggards will be things like utilities and consumer basic, the staples, healthcare, those kind of things. Doesn't mean they won't have appreciation. I'm sure they will in that kind of market environment, but they're not going to be able to keep up with some of the leaders.
And this potentially comes throughout this year and maybe into the foreseeable future. But as you talked about, there will be this inevitable shakeup or the bust. Now, again, thinking ahead to the future, you've talked about this on countless podcasts and discussions about your sort of prediction onto the next bit. And I fear it's one of those positions that we're going towards this incredible melt up and then the bust. I can imagine you talking about this. It's almost a relief to not see it happen. But if you were trying to think ahead and it's markets, it's almost impossible to figure it out. What might be some of those top signals that we go, all right, this is now venturing into the bear market territory or the next prolonged bear market? What would your thoughts be there?
Yeah, from an economic standpoint, keep in mind, I'm thinking we are either in recession, probably very close to recession. You had some buying ahead of the tariffs, so that kind of boosts second quarter numbers. So you look and you say, oh, second quarter is okay, but you got to be aware that you fall off a cliff after that because they are kind of borrowing from the future. So I think this summer you will be in recession, and recession is the precursor of the bust. The bust is just a more extreme, as it gets worse, it reaches a point where you get a financial crisis accompanying it. So from an economic standpoint, I think we will evolve from recession into a bust, and whether the bust actually hits before the end of this year or spills into, doesn't start until next year, we'll probably be in recession second half of this year. So it's not like the bust all of a sudden comes out of things are booming and then they go bust.
Yeah.
We'll be sliding towards there. From a stock market standpoint, I think the biggest tell will be sentiment. When you see everybody all in and starting to extend the cycle and tell you that, because I am a contrarian, I'm going to be early probably and be alone probably at the top or pretty close to alone in terms of saying it's time to exit stage right, and people are going to go, no,
what are you talking about? The show goes on.
Long cycle ahead. This thing's just getting started. When you hear that kind of conversation, initially it'll be some people, but as you hear more and more people buying into that rhetoric and saying, you can't fight this thing. It's got legs. It's going to go. The Fed's just starting to ease, so you got 2-3 years to go on this cycle or whatever. That should be the beginnings of people saying, hey, maybe people are getting caught up in the tape. So that will be a big sign. And then obviously some of the things with the policies and, stuff. And if you see the bond market accelerating to the upside because rates are falling sharply, because the economy is starting to accelerate to the downside, those are things that I think you start worrying about. taking those signals and saying, what I don't want to be is late. You can be early and miss a bunch in a parabolic run. I talk about that now. If you listen to so many people and got out in the last month saying, well, I don't want to be a hero. I'm not going to be able to call the top, and maybe we're near a top. I don't know if we're at the top. All of a sudden, you're missing 40 or 50% upside. And what's going to happen is you got out because you were nervous that we were near a top. And then you're going to be jumping back in near the top because you're listening to voices telling you there's years to run. So that's what you don't want to do. What you can do is be early. What you can, you don't want to be late in this thing where you do get in near the top, or you do get greedy and say, oh my goodness, this thing has legs. And then you get caught because that first step down on the other side of the mountain could be fast and deep. You could be down 30% before you blink. I don't know that. The top might build. You might get up near the top and be at that top for a few months, or you might top tick and be down the next week and say, well, yeah, but this can go up again. And next thing you know, you're down 20%. And then you say, well, yeah, but now it's oversold. It's going to go up again. Next thing you're down, 30 or 40%. So it's hard to know how the others, how this thing will play out exactly. So you don't want to think you're smart enough to call the top, and you don't want to think but you also don't want to be listening to all the, I call it noise, but all the chatter out there from so many people that are on the wrong side of this thing.
And then
they fought it all the way up, and then they're gonna join the party and then miss the downside.
And it was no less than really 5 years ago that when COVID-19 was hit, we had huge global government interventions and bailouts. Now, I don't know how much we've learned from that whole cycle and what intervention can lead to markets. If this potentially does happen, do you feel that it then puts these institutions in a position where they feel they have to intervene in the free market again to provide that soft landing for the everyday punter that's investing or that's getting burnt by this? Or do you feel that this is, again, repeating the same cycle that we were just in 2020?
Yeah, it's ironic. The thing is that 2020 taught other policymakers lessons, right? You're hearing it from Jay Powell, you hear it from Lagarde, you hear it from all of them. We don't want to repeat the mistakes we made during ZIRP. We don't want zero interest rate policy. We don't want to go back there. We're not going to print money like crazy. We know the downside of doing that. So they're all telling you that they've learned that lesson and they're not going back there. It's that very rhetoric that is causing me to say that's why we'll have a bust, because they're going to be slow to respond, and when they do respond, they're going to be responding in very timid ways, and they're going to say, yeah, we told you we're not going to, yes, the market's selling off big time, but we're not in the business of supporting the market. You can hear all that stuff. And then when they do come in, even if they do, let's say, I'm just talking about the Fed, but let's say they do $1 trillion in new money, $1 trillion in QE, because things are starting to really rock and roll on the downside. That trillion is going to be far inadequate because you're in the biggest unwind in history. So they're not going to, there's two things that I think are going to cause them to be very inadequate in their response. One is that they're going to, they so-called learn the lessons of the past. They learned the 2020, the most recent past, and they're not going to want to repeat that. And secondly, we're heading into uncharted territory. As bad as 2008-9 was, as bad as 2020 was, this is going to be even far bigger because the leverage is far greater. And so it's uncharted territory for a banker, for a policymaker. And so they're going to be trying to use past and not wanting to use recent past because they said they don't want to do that. And this thing's going to be so much bigger, and the need for even bigger response, not smaller response, is going to be so great. And all of a sudden, you're sitting there way behind the 8 ball. You should be printing 10 trillion, and you're printing $1 trillion thinking that was too much, and so it'll take them time to get to a right-sized policy. It'll take them time to catch up to what they need to do. And in the meantime, and when I say time, probably months, but markets will be moving
days, weeks, minutes now.
Yeah, exactly. So it's gonna be a rocky period until they finally figure it out. Again, no way to pinpoint time on that, but my guess is we top out in the market, like I said, probably within the next 6 months or less. We see the bust start either late this year or early next, and then you got 12 to 18 months of rough sledding. I think the likelihood is first half of we find the bottom in the economy first half of 2027. Might be early 2027, might be mid 2027. I don't know. It's too early because we don't even know what we're heading into yet. But the market will bottom many months before that. So you could have a bottom as early as the middle of next year, summer of next year, might spill into, I'd say probably third quarter next year might be a bottom. Could spill into fourth quarter.
And if I bring this back to the modern day context where we are right now, there's been this emphatic switch in investors' appetite for certain resources, and I think this has pivoted throughout it. But I saw you've talked about your adjustments in gold in particular and the targets you have for that. Now, for many investors, gold is always seen as a safe haven. And I'd just like to unpack your thoughts on why we've seen suddenly a resurgence in that and what might happen as the markets do go up. Naturally, gold should cease, but not cease, but drop. And then as we do hit this system where markets fall away, gold should naturally rise. But it sort of feels that they're kind of going in tangent at the moment, which means from an investment point of view, how can you best potentially prepare and or strategize yourself effectively?
Yeah, I was way ahead of most people, I think, on this because there's still very strong voices out there that believe gold moves opposite to the stock market. And obviously they've both moved up together. And I'd go back and point out the first decade of this century, the period in say 2005, 6, 7 through 11. In there were strong stock markets and strong gold market during that period. So they can move together. Sometimes they do, sometimes they don't. I think we make the mistake of kind of wanting everything to be black and white. Why is gold moving? It's a safe haven trade. Well, some people are buying a safe haven trade because they are worried about the huge deficits around the world. They are worried about the problem in sovereign debt and the fact that interest rates could go up. They are worried about the world, the potential for a world war. What's going on in Gaza, what's going on in Ukraine. That's all safe haven type things. There are other people buying it because gold responds to lower interest rates. They may be like me, anticipating that ultimately the Fed's going to have to ease here and ease in a big way. So it's not a monolithic buyer. There's many reasons to buy gold. And probably the biggest reason, if truth be known, is the tape's moving up. Gold's got momentum and investors love momentum. So when gold breaks out, all of a sudden everybody's bullish, people. So we can attach rationale to why things go up, but oftentimes they're going up because people are jumping on the bandwagon. They're buying momentum. And gold, as you know, I mean, I've raised my target. It was 3,000. I raised it to 3,400 last year sometime, and I've raised it to 4,000 now back in my April newsletter. So I think 4,000 is very likely here this year. Doesn't mean it has to stop there, but that's right now I feel pretty good about a 4,000 target. My silver target, which is poor man's gold, although it has other demand reasons, but is just starting to break out, and not to new highs, but certainly above a long consolidation period. And I see silver going to 75 this year. So, and that's been a target I've had for quite a while. So that seems extreme to a lot of people because silver lagged. And more importantly, the miners lagged, but I think the miners are starting to show life and break out. And so I think you're going to see it's been a long wait for those that have invested in miners, but I think they're going to be rewarded here in the next 6 months.
Yeah, well, in Australia, the miners have been doing it tough, and the disparity between the explorers and the producers has been just exponential. There's been a massive gap between them, and I think many of them would be quite happy to hear you be saying that because they have been doing it tough. But going back to the idea now that the modern day investor, they've got access to global markets at their fingertips and they can really make decisions instantaneously. The psychology and the ability to stick to a game plan and or a strategy is almost, it's a great idea, and people still struggle and will always struggle to do it. What are your, I guess, thoughts and processes and even practices that you employ yourself to stick the course, because you've done it for your entire career with so much noise? What's your best sort of strategy and or advice to those that are probably going through this tentative period of time and going, how do I stick to it, and who and why should I listen to yourself and potentially others?
Yeah, that's a great question because I see it every day on X. I got it this morning because silver's having a great day, and people want to either they're getting excited because it's going up, or they've been trained because silver's been disappointing for a long time. They've been trained that every time you get one of these, the next day is going to be down, or very soon you're going to be disappointed because it's going to go the other way. The markets love, it's like Pavlov's dog. They love to train you and get you to react. And usually by the time you've figured it out as a retail trader, retail investor, you've learned all the wrong lessons and it goes the other way. So I preach all the time, for most people, investing rather than trading is the way to go. Unfortunately, certainly the younger generation have been raised on video games and everything's kind of instant gratification, and they want to invest or trade in that same vein. It's counterproductive for most people because it is tricky business, to say the least. It's easy to think you got it figured out. Just when you think you got it figured out, it'll go the other way. So I encourage people all the time to understand that patience is a virtue when it comes to investing, that the best thing you can do is buy when people are selling, and then just stick with it. And sometimes it's a long time. Sometimes you get rewarded in 6 months or a year. Other times it's 3, 4, 5, 6, even 7 or 8 years but if you've done your homework and you stick with it and you see things along the way to keep you there, that long wait will be rewarded. And that may seem impossible for many people who think, no, I gotta see my investments advance or I'm going to get out of them.
Yeah.
More often than not, if you step back and looked at your record, you'd be getting out of things that you should have kept and getting into things that you should not have gotten into. So it's hard for people. I was a pension fund manager for a long time earlier in my career, a successful one. And pension fund investments is a longer term game anyway, because you're investing for people's retirement. So that helped. Being a contrarian and a value investor, you learn that kind of an approach anyway, because you're investing in things that are out of favor, and you have to wait for them to come into favor or wait for the turnarounds and things. So that's in my nature or in my my background anyway. But I'd say for everybody, whether you're more of a momentum player or more of a want to be with the crowd type of thing, even there, trying to be a jackrabbit in and out is it's a very hard game
Yeah.
to be successful at. There are good pros that can do it, and even some good retail people that are, have that mentality. They just have, it's a component of the brain, I think, too, that some people are just have a knack for it. I've noticed that throughout my years. But for 95% of investors, probably more than that, I would say being a trader is going to prove counterproductive to you. That doesn't mean you can kind of figure out your own, what works for you. And there are people, not you don't have to be a day trader, but there are people who will say, yeah, I don't want to be greedy. I made 30% in this stock and I'm taking a profit, and you never get hurt taking a profit. So it's not to say that you can't play that game, but I think for most retail investors, buy and hold works. That being said, we're in a period where buy and hold is going to get punished, because I am calling for an 80% bear market. So there is going to be a point this year where I think for most people, it would be wise not to be a buy and holder, but to be saying, hey, I've made my money, I don't want to get greedy, and I am coming out. But that's not week to week, month to month. It's really, there's going to come a time later this year, as we talked, where we top out, and the other side of the mountain, I'm predicting an 80% bear market. So if you ride this out and you happen to be, and that's the market, so that's across the board in stocks. Some will decline less and some more, but if you're down 80%, that means most stocks are down a lot. And if you go down anything close to 80%, it's a long climb out just to get your money back. For those that think, because the mantra has been correct since the mid 80s, it's time in the market, not timing the market. It's been a correct mantra for a long time. But if you stick to that,
you're going to be in there a long time.
I think is coming up, yeah, you're going to be disappointed, I think.
It flashes me to I remember when Berkshire Hathaway was talking about cash sitting on the sidelines and waiting and picking when it would go, and everyone reads and looks at what he accomplished over his years, and it all festered in the later years. And I don't think many people understand that it was a long period to get there. But the idea of sitting on cash and being patient is a skill that not many of us have at our disposal in this sort of current, as you said, dopamine
and frankly,
scrolling environment.
Most of Buffett's money was made buying things out of favor and then holding them for a very long time, or buying things that had long cash flow predictability and just letting that cash flow build. His was not a timing strategy. He did accumulate at times when he thought the market was, too rich. He'd say, I'm just not comfortable, but I don't see anything I really want to buy. And he'd sit on it, let that cash accumulate. But more of his wealth was really built on a buy and hold, buying good companies that had strong cash flows and buying them at the right price.
And one of the fascinations which I've loved about you is your openness to talk with so many people, but it goes beyond the talking, which is really what you do in a lot of your time, which is the writing and the researching. And now you've got a newsletter that you send out to anyone that subscribes to it. But for those that are unfamiliar with that, and I'm sure many know of it and or are consistent readers, can you explain a little bit about what you provide? Because it would really be more detailed and synthesized versions of a lot of what we talked about, but more directly to your inbox more frequently than a chat that we get every 6 to 12 months.
Yeah, I write a quarterly investment letter, a macro letter. It's not a trading letter. It's not giving you ideas to trade on. It's basically, like you said, kind of what we've talked about here, what people see me talking about on X all the time. But it's a quarterly letter where I can synthesize my thoughts in a longer form, generally 6 or 7 page letter. And it, it goes through the various markets, bonds, stocks, metals, the dollar, currencies, the dollar, and oil and other commodities. Talk about sectors, etc. But it's not really a lot different than what I do in my videos, or a lot different than X, other than it is because it's longer. I can give my rationales in a more thoughtful process, not sound bites. And it is, I've been writing it since the year 2000. I wrote it for institutions when I was on the street, and for clients of the institution. So it was for institutions, but then I realized I write and speak pretty plainly so people can understand. It's, yes, there's some Wall Street jargon there, but mostly I think I'm pretty plain spoken. And for the last 5 or 6 years, I've had the letter available to retail, and most of those that subscribe tell me that it's very clear and has helped them a lot. It's for it's a subscription at a price, so I don't want people bombarding me with requests saying, "Can you send me the letter?" I get that one quite a bit, thinking it's just a freebie like the what's on X, but it is for a cost. It's not for everybody. Some people can't afford it, or some people just don't want to pay for anything. But those that subscribe, and I've got a decent subscriber list, I generally get, I would say, something close to 60 or 70% re-upping each year. So that's a pretty good sign, because I think in the subscription business, you're lucky if you get 25%.
Yeah,
massively. And the people do subscribe. Certainly long-term subscribers tell me it's helped them a great deal in terms of thought process and understanding.
Oh, beautiful. And I think in closing, because it might be another 6 or 12 months that we speak again, if we review this and we come back to it, what would be the one potential thing that you look at and be, I got that right or I got that wrong in 12 months' time if we listen to this again?
Well, I will say if I get it right, we're in for a very memorable year, because I'm talking about things even 2008-9, which was biggest financial crisis in history to that date, and certainly a pandemic was another period of kind of unprecedented type moves in fast times. If I'm right about what's coming, it will be very memorable. If I'm and we'll be making history, and you won't forget that period. If I'm wrong, where am I wrong? Judging from what's been my history for the last many years, and I get beat up on Twitter for this.
The haters always come out in force.
It's that it will take longer. That the cycle gets stretched even further. I don't think that's the case, and I'm not trying to mislead people, or I get accused of just moving the goalposts down the road. That's not what's happening. Market cycles, these big market cycles, it's impossible to precisely time them. I do the best I can, and I think I do it better than anybody else. But in terms of the overall cycle, in terms of forecasting, but if I'm wrong, it's probably that this thing gets extended even further. Is it possible that the bust is something less than a bust? That it's a recession, bad recession, but we don't get a true bust? That's always possible. My conviction is pretty high that I've been forecasting this for a while and haven't changed my tune at all, because everything seems to be building towards what I've talked about.
Yeah, well, we've spoken, this will be the third time, and I think back to our first conversation, it's all been heading there. So who knows, in 12 to 24 months' time, over the next conversation we have, it might be very different conversations if it's going on this trajectory. But thank you so much, David, for coming back and speaking on the podcast. It's always an eye-opening and incredibly enjoyable experience. And you nailed it before when you said that you talk about a lot of complex conversations and market fluctuations and make it digestible and easy to understand. And that's what many look for in this day and age. So thank you so much. And I'll put all the details in the descriptions for those wanting to contact or reach out to David. But thank you so much for coming back on the show.
Yeah, thanks, Ben. Thanks for having me again.
Thanks for listening to the Market Bull podcast. Please remember that the topics and stocks discussed in this podcast are not financial advice. If you enjoyed this episode, please make sure to like, share, and follow. You can follow The Market Bull on all our socials and keep up to date with global market insights.